This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Let's move on, though, to our post-game chart book. Listeners, you'll find the download link in your Research Roundup email. If you don't yet have a Research Roundup email, it means you're not registered at macrovoices.com. Just go to our homepage, look for the red button that says Looking for the Downloads right above Jesse's picture. Patrick, as we dive in and look here at page 2, you've got your usual S&P 500 chart, but this week you've added panels for momentum and rate of change, subgraphs. What's going on with this particular chart?
Well, Eric, over the last several months, we've been talking about the parabolic rises in many of these FAANG stocks. And usually what you see is an acceleration in the rate of change as they're rising. And I thought it was particularly interesting that we're seeing quite a divergence from what we're seeing in the broader markets. Now, of course, in the very first reaction off of the March lows, when you have such an extreme oversold condition, like we saw during that historic market crash, the reflexivity of an immediate bounce is always going to have a very rapid rate of change. And so expecting the rate of change to shoot higher in the most immediate impulse after a crash is expected. But what we continuously are seeing month after month is the rate of which the stock market is rising is slowing. It's just getting exhausted from this rise. And as it's slowing and slowing, we're seeing all sorts of divergences in the momentum since its July highs, as well as the rate of change is making a sequential series of lower highs and is heading down to the zero line. And traditionally, and one of the really interesting things to watch is traditionally this has and can precede some form of a market correction. And it'll be really interesting now that we're going into out of the summer doldrums and going into not only the post-Labor Day when there's typically very large amounts of volume, but we also have a big options expiration roll-off. There's a big gamma pinning the S&P in this 3350 to 3400 zone. And so as we roll that off, go into Labor Day, and now several months away from a U.S. election, are we finally going to see some material volatility? I mean, you were referencing the fact that Charlie McElligott was talking about that, and it really, I think, has a very good chance of happening. But when I look at a chart like this, spidey senses are telling that we're probably first going down before we go up.
Well, Patrick, I couldn't agree more that when you see a divergence where the most common names are performing very well and the lesser known names are not performing so well, that breadth divergence is usually a very bearish signal. Let's move on to page 3, where we're looking at a chart showing that the outperformance of the FAANG stocks: Facebook, Apple, Amazon, Netflix, Google. Now, what is this chart telling us? Because on the one hand, I can see that, okay, clearly for the last month, there's been huge outperformance of the FAANG stocks compared to other stocks. But, if I look back over the last, going all the way back to March, it seems like there have been lots of periods where there was a big outperformance of the FAANG stocks, and that would have been that same breadth signal that maybe would have been bearish, but it didn't really have a bearish outcome. So how should we interpret this now?
First, most basic observation is just how much those 10 companies that make up the FAANG Plus index, and this is the index future. So it's the normal FAANG stocks plus it adds Alibaba, Baidu, Nvidia, Tesla, and Twitter into the FAANG basket. And that has been where the vast majority of the performance has happened. And particularly, it's noteworthy that since July, this FAANG index has been making higher highs, and it's been driving the market higher. But what is particularly interesting to me is that since those July highs, only 3 of these 10 stocks made higher highs. And 2 of them have the stock split momentum of Apple and Tesla, as well Nvidia. And the other 7 have actually not made higher highs. So it's not only that it's a more narrow breadth and it's only the FAANG stocks rallying. Actually, in the last month, it's only been a part of the FAANG index that's been driving this momentum. And so whenever you see those kind of divergences where fewer and fewer stocks are driving almost all the momentum, to me, that's a red flag. And this is something that it's going to be high on my watch list over the next a week or two.
Let's move on to page 4, where you're bringing global equity indices outside the United States and comparing those to the S&P 500.
Right. And everyone is continuously anchoring off U.S. equity markets to already call that this is the end of the bear market and that we're in a new bull market. But when you really look at the global equity markets broadly, they have been massively underperforming and very few have actually even approached their previous highs. So, I mean, when we're looking in the S&P 500 retesting those February highs, it's definitely there. But when you look at something, for instance, take the London FTSE or the Euro stock, they're still materially down and nowhere near their year-to-date starting levels. And at the same time, the Nikkei and even the Canadian TSX, or even if we had up here, let's say the Aussie 200, they're all actually lagging quite considerably. And what's interesting is the emerging markets have done very well, particularly driven, or at least on a relative basis, driven by India and Brazil and a few of these other markets that actually have been doing half decently recently. But just today, we saw some material breakdowns in the emerging market ETF. And so we're starting to see the global equity feel very toppy and almost rolling over. And it's really the U.S. equity market held up by fewer and fewer stocks that is holding this whole thing up. It would not surprise me at all if we began some sort of mean reverting correction. I don't want to necessarily all be saying something overly bearish like we're going all the way back to previous lows, but it would not surprise me if the break was to the downside coming into the post-Labor Day period.
Let's move on to page 5. You're showing the U.S. 10-year Treasury yield just taking a nosedive, of course, with the pandemic crisis, bottoming out in the bottom of March. Great big dead cat bounce, back down and retesting that low with a double bottom. Then kind of consolidating, looking like it was going to recover up into the middle of June. And then we're back down to new lows as we got into August. So what is going on here with the 10-year and where are we headed from here?
Well, the one thing, like I wanted to use the 10-year just simply as a reference point because I want to talk about actually corporate bonds. And so the real takeaway here is that we've been very much stuck in a trade range, but the sequence of lower lows and lower highs has been quite uninterrupted for quite a while. And anyone that's already counting on a major reversal, we haven't seen a change in this pattern. I mean, maybe if there's the inflation expectations start to rise in some meaningful way, maybe the yields will start to reflect it. But I don't think that this is yet enough technical evidence to say that some major new trend is developing. But really what I wanted to anchor off of this is the fact that yields are generally pinned lower. And I want to talk about the break that we have seen in the investment grade and junk bond markets over the last couple of weeks. So when we go to page 6, you can see the chart there on the investment grade corporate bonds, which had a pretty significant break, wiping out much of the last 1 month's rise in one fluid motion, and has not been really able to start to recover in the last few days off of that. And what's particularly interesting is that the first reaction down was very much in line with that recent little pop in the 10-year Treasury yield. But what's interesting and what will be something that's going to be on my watch list is on page 7 when we're looking at those OAS credit spreads. And you can see those investment grade credit spreads, while they shot up from about 100 basis points to about 400 basis points during the crisis, ever since the Fed stepped in to stabilize the bond markets, those credit spreads have narrowed almost back down to the levels where they were prior to the crisis. And what will be interesting to see is if we see the market start to get nervous and whether or not these credit spreads start to widen again. We haven't seen that break, and that's something that's on my watch list to see whether or not we finally see a turn and whether these start to rise. No sign of it yet.
Let's move on to junk bonds, high-yield corporates on page 8. It seemed like we were finally getting that break, I guess, because of the crisis. I wasn't really expecting junk credit to recover from there the way it has. I mean, we're not quite back up to the previous highs, but we're pretty close. What's going on here?
So, Eric, when we're looking at high-yield junk bonds, the one thing that I find really interesting is that they continue to look like they're correlated with the broader equity markets. And when we were showing that rate of change and momentum on the S&P chart earlier, if we were to put them on this high-yield corporate bond chart, you would see the same divergences. And there continues to be the rate of change of the rise slowing. And this, to me, makes it very toppy. It's a market that could very easily roll over. So when we go to page 9 there, we can see that the credit spreads on junk bonds over that of the Treasury before the crisis was around 350, 400 basis points. And we have more or less erased this. And in spite of all of the risks associated with so many of these high-yield junk bonds, especially in this post-COVID period where many of these companies that are on the periphery could still realistically default, and there is all sorts of risks associated. Much of that risk is not being currently priced into these. We're about 500 basis points above Treasury, which is, to me, a very calm and orderly junk bond market, which I don't think will stay that way.
Well, why don't you think it would stay that way if the Fed is going to continue to bail it out? I mean, it seems to me like what changed here is the Fed announcing that they're going to buy junk bonds with taxpayer money, which I think is completely immoral and illegal, but it doesn't slow them down.
Well, I think there's a difference between the Fed providing liquidity to keep an orderly market versus them directly trying to manipulate junk bond yields so that low-grade credit companies can access the debt markets and borrow at rates much lower than they should be. I don't actually think that there's a lot of moral hazard, just like you're suggesting, and I don't think it's the intention of the Fed necessarily to somehow manipulate these interest rates lower. Rather, I think it was the fact that the ETFs have just become so big that there was a real liquidity risk if they didn't provide liquidity into that market. So I actually still think that there's plenty of room for junk bonds to actually have a freakout moment. I think everyone's getting a little too complacent about that.
Well, we'll see what happens. Let's move on to volatility on page 10 with the VIX index. What's going on here, and what's the blue consolidation range telling us at the bottom? Looks like we're coming back into it.
Well, this is the thing. When you go back and look at even the last 2-3 years of the bull market prior to this drop, we saw volatility stay consistently in the 10 to 20% range where it consolidated in that period where we saw everyone generally being short gamma in a very big way. Since the crisis, volatility has been narrowing or coming off of its major crash highs. And the question now is this now going to stay at an elevated level of volatility, or are we genuinely in some sort of new bull market where volatility will come back into this traditional long-term range? I personally think that this is a very important moment. And when you look on page 11, what I did here was compare the S&P 500 implied volatility and compare that to the 30-day and 100-day actually realized volatility. And what we can see is what's been dragging on this lower has particularly that 30-day volatility, because of this narrow range the stock market has been in into the summer, has been dragging realized volatility down, which is keeping implieds very low. But going into a U.S. election and a post-Labor Day liquidity surge that I think will potentially drive some material volatility, I think that this realistically could be the bottom end range of implied volatilities in the VIX, and we could potentially see volatility return in the coming months. And so this is one of the really interesting things to watch.
Patrick, we got to touch on gold before we finish. On page 12 here, you've got the gold chart, and you tell me, but, as I look at this chart, I can see the consolidation range, and, it looks to me like the top of that consolidation range, you could call it anywhere from 1765 up to 1800, but let's say just because the market has been strong, I wouldn't want to pick a low number to wait for it to come down to, but it seems to me like it's reasonable to expect a technical correction to come back down to something just above 1800 before this market marches higher. What do you think?
Well, I'll tell you, my intuition is that the bull market's not over. And what I feel like in a traditional consolidation, and especially if it zigzags downward, you can see one more drop here that could potentially see like 1850. And definitely, if it was a bull market, we should stay above those consolidation highs of April and May. So printing below 1800, even if it temporarily drops below 1850, it shouldn't stay down there very long if it is going to be bullish. The characteristic that you typically want to see in a proper bull market is that all dips are being aggressively bought, which is that they don't stay down very long even if they do break. And that's actually what I'm going to be watching for. Is that characteristic of buying dips going to remain there, or is this going to become far more distributive in its price action, which means that maybe some sort of bigger or more prolonged intermediate high is in place that will lead to a multi-month correction in gold? And I'm not totally sure I'm sold on which one. My intuition and benefit of the doubt goes to the fact that the bulls will buy the dip here. And I think that if the market was to gift a technical drop down to like 1850, it's an interesting place to be buying, calling for the next leg higher. So that's definitely what I'm watching. But I wanted to, on chart 13, ask you. You asked us to put this chart in there. What are you showing here on page 13?
Well, Patrick, this gets a little bit more technical. We're getting now into the term structure of the gold futures market, the difference between one delivery contract and the next in terms of price. And, it astonishes me what it is about the gold market that causes there to be more misinformation than accurate information on the internet. I just don't know. I was really disappointed to see Zero Hedge run an article recently by some clown talking about how the deep backwardation in the gold market portends a signal of shortages and so forth. There's absolutely no backwardation in the gold market. The gold market is not only in a very steep contango, it's in a situation where the contango is greater than what's known as full carry, or in the oil market, what a lot of people like to call super contango. In other words, if you were to buy the December 2020 gold futures contract and take delivery of gold on that contract, put it in storage. Well, what's it going to cost you to store that gold? Somewhere around 50 to 75 basis points if you're an institutional account. So you figure that we're talking about, between $10 and $15 an ounce that it's going to cost to store the gold for a year. You've got to finance the purchase of that gold if you're going to evaluate the carrying cost. But, the cost of Treasury bills now is, 10 basis points or something. So it's almost negligible. So you would expect that the maximum contango, what's called fair value or full carry, is somewhere around $15 to $20. If the 2021 gold contract is more than about $15 to $20 higher than the 2020 contract, it's creating a risk-free arbitrage where you can make a guaranteed profit without taking any risk on what the price of gold does, simply by buying the 2020, selling the 2021, which means you make what was at one point a $46 differential. You put that in your pocket, and all you got to do is pay to store the gold for a year, which is going to cost you $15 or $20. You end up pocketing $25. That's a guaranteed return of about 2%. Now, 2% doesn't sound like a lot, but this is essentially a risk-free guaranteed return. In order to not make that return, the exchange has to completely collapse. And so if you look at the other risk-free returns, which are Treasury returns that are yielding just a few basis points, it's a really big deal. How do we get down to the point where there was a $46 difference between the 20 and 21 December contracts? I talked to Kevin Muir a little bit off the air about this. He did some checking around. Kevin thinks what's going on here is the traders who know how to put that trade on are mostly bullion bank traders. And a lot of those guys have kind of had their capital chopped off because of the Volcker rule and just restructuring of their banks. You can make guaranteed money on this, but it's capital intensive. You got to buy a whole bunch of gold and sell the futures contract, and you end up making a guaranteed return of 2%. Well, they don't have their own company's capital, and they have to go out to their customers and try to find somebody that wants that 2% guaranteed return, and they're apparently not finding it. Looks like what happened is that got to the point where the extreme contango was so far beyond a full carry at $46. Somehow that trade finally caught on. A bunch of people realized, hey, there's free money on the table here to arbitrage this inefficiency, and that's why you see the steep recovery. I think the reason that this is interesting to retail investors and sophisticated private investors is the usual trade-off is, you can buy the ETF or you can buy physical. Now, physical has a lot of advantages. It means you're completely independent from the financial system. You're not dependent on the stock market still being there for your ETF shares to be worth something. But if you're talking about, just a few $1,000s that you could store in your home, then I guess it doesn't cost you anything. For any appreciable amount of capital, you would never want to store it in your home because bad guys will find out you got gold and come and kill you and your family in order to get it. So you got to pay about 75 basis points to store it. So if you want physical, it always costs more than paper gold. For the first time, really, that I can remember, physical costs cheaper. The carrying cost of buying and storing physical gold in a private vault where you own it and you're completely independent of the financial system is actually lower than buying the futures contract or a paper instrument that trades the futures contract. So where a lot of people used to be just totally, it's got to be physical metal stored in a vault. And I used to say, look, I just don't think the COMEX is going to go out of business. I'm comfortable making my gold investments by carrying futures contracts. It's actually cheaper to do it in the physical market now, or even with an ETF, actually, like GLD, which owns all of the gold as opposed to using futures contracts. Futures have become very efficient because of this arbitrage that hadn't been taken. Now, it is starting to come back out. It's going to be very interesting to see whether it comes completely back out. Patrick, before we close, let's hit page 14. What can our listeners do if they want to get in on a free trial to your service, Big Picture Trading?
If anyone is interested in just seeing what I do on a regular daily basis, where I analyze the macro markets and call all sorts of trades, you can sign up for a free trial with no credit card required at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.